So if you've ever tried to build an ETF portfolio yourself, you probably know that feeling, right? There are just so many options, and it's really easy to feel completely overwhelmed. Well, in this explainer, we're going to cut right through all that noise and lay out some clear, time-tested strategies to help you find what actually fits you. And we're going to kick things off with this fantastic quote from the investor Howard Marks, because it really sets the stage for everything we're talking about today. See, the goal isn't to find some single, magical, perfect portfolio. The goal is to find the one that lines up with your life, your goals, and how much risk you're comfortable with.
And that's the big question, isn't it? With all these different portfolios and expert opinions floating around, it can feel like total analysis paralysis. But don't worry, we're going to give you a clear map of a few different approaches, from the incredibly simple to the, well, a little more ambitious.
Okay, let's start with the most straightforward path you can take. This one is for anyone who just wants to keep things simple, get started right away, and not get bogged down in all the details.
This is it, the one fund portfolio. And the idea here is actually pretty powerful. You're basically making one single bet on the long-term growth of the entire global economy. It's the ultimate set it and forget it strategy. And trust me, simple does not mean unsophisticated.
The real beauty of this is its simplicity. You've got one ETF, one asset class. But inside that one fund, you get a piece of thousands of companies from all over the world. And hey, if you pick what's called an ACWI fund, that's an all-country world index, you'll get emerging markets in there too. It's about as diversified as you can get with the least amount of effort.
But here's the trade-off, and it's a big one. On one hand, you get maximum simplicity and, historically, really strong long-term performance. But the flip side is you're going to feel every single bump in the road. With no bonds or anything else to soften the blow, you are fully exposed when the market crashes. So this strategy really demands patience and a very long-term view.
So, what if the idea of a 100% stock portfolio makes you a little nervous? Well, if your main goal is to grow your savings steadily, without losing a bunch of sleep over it, then these next few portfolios are probably more your speed.
And this quote just perfectly captures that mindset. Our source material talks about an investor named Sandra who saw a balanced portfolio and her reaction was immediate. She just wanted something simple and effective to get going. It's all about finding that sweet spot between growth and stability.
So here we have three classic strategies for stability: the prudent, the permanent, and the famous all-weather portfolio. And you can see the common thread, right? They all dramatically reduce how much they hold in stocks and bring in other things like bonds, gold, and cash to act as a buffer. Each one mixes those ingredients a little differently, but the end goal is always the same: a much smoother ride.
All right, let's totally flip the script. For those of you who have a longer time horizon, we're talking 15 years, maybe more, and you're okay with a bit more risk, let's look at a strategy designed to really maximize performance.
The whole idea behind the growth portfolio is to lean into that risk to try and capture higher returns. And it does this by intentionally putting more weight on the types of assets that have historically grown faster, even if that means the journey is going to be a whole lot bumpier. And you can see that philosophy right here in the allocation. We're starting with a big 70% in world stocks, but then we're adding some extra horsepower. 10% in emerging markets, another 10% in small cap stocks, smaller companies with more room to grow, and even a small, speculative 5% slice of cryptocurrencies. Yeah, gold is still in there, but it's just a tiny piece now, mainly for a little bit of stability.
So the takeaway here is crystal clear. The potential for higher rewards comes with much, much higher risk. A portfolio like this is going to see some really big swings, both up and down. To manage a strategy like this, our source material says it's pretty much essential to have a separate strategic reserve to keep things stable.
Okay, so we've seen simplicity, we've seen stability, and we've seen aggressive growth. So how do you actually put these ideas together into something that works for you? Let's break down the personal portfolio from our source, not as something to copy, but as a really great example of how you can blend these different principles. This portfolio is all about balance. It's got a solid 50% in stocks for that growth engine, but it also has a good chunk in real assets like commodities and real estate. But the really interesting part, the game changer, is that huge 30% slice called the strategic reserve. And that 30% is the secret sauce. It's not just cash sitting around doing nothing. The source describes it as an active, strategic tool you can use for both defense and offense. So here's how it works. It's split into three different buckets. The first 10% is for true emergencies, easily accessible in a savings account. The second 10% is in something a little higher yield, but still safe.
And that third 10%, that's the dry powder. It's kept in a low-risk fund, ready to go, so when the market takes a dive, you can actually buy assets on sale. It's a strategy that turns a crisis into an opportunity. Okay, let's wrap all this up. As you start thinking about what your own portfolio could look like, here are the big ideas, the main principles you'll want to keep in your back pocket. Just remember, all these models we've looked at, the simple one, the prudent one, the growth one, they're just starting points. They're not strict rules. The real goal here is to take inspiration from them to build something that you feel good about, that balances your desire for growth with your need to sleep at night.
And you know, if you only take one single thing away from this today, let it be this word: allocation. Deciding how you split your money up between stocks, bonds, gold, and everything else, that is the single most important decision you will make. It's going to have a much bigger impact on your results than trying to pick the hottest ETF of the year.
At the end of the day, the best portfolio isn't the one with the fanciest strategy or the highest return last year. It's the one you actually understand, the one you can stick with through thick and thin because you know why you own what you own. So, now that you've seen the map, what's your next step going to be?